click yourself onto Three Guys and an iPad, the only mortgage-focused podcast that somehow remains ineligible for the COVID vaccine. I'm Brian Rieger. I'm one of those three guys and one of your hosts today. And I am the founder of Content Beacon. I'm joined, as always, by my friend and co-founder at Content Beacon, Rick Grant. Rick, how are you today?
Good, fine. Brian, it's good to see you. The snow has stopped here in Wisconsin, so I should be able to remain for the entire length of this podcast.
Well, I'm excited to hear that. Just throw another log on the fire. And we're recording this on April 21st, but anyone in Milwaukee and Cleveland is looking out at 4 inches of cursed snow. So hopefully you're not where you are by the time you're watching this. I have some good news this week. We are rejoined by our third guy, and as we like to call him, the eye candy of three guys and an iPad. From Austin, Texas, Kevin Breland. But Kevin, you've got a little news for us, don't you?
I do. I have recently joined the Guaranteed Rate Affinity. That's why I've been away from the show for a few weeks as I was going through the onboarding process and the background checks and all of that. I had to get my state license up to date. And so I've had all of that activity going on the last 6 weeks. It's been pretty busy for me, but I'm happy with the change, and I'm really happy to be here today with two of my good friends. So I look forward to the show.
Well, congratulations, Kevin. You cut out a little bit, so for those of you watching who missed it, Kevin is now at Guaranteed Rate, an ample reward for a fantastic 2020. And we'll get some of that information into the show notes as well, right, Mr. Grant? So, but enough about the three guys. Let's get to our special guests, and we have a great one for you today. It's been about a year since our first special guest was last with us. He's got close to 40 years in the mortgage banking industry. You probably know him from his time as the Assistant Secretary of Housing and the FHA Commissioner. That was during the Obama administration. And many more of you know him as the CEO, longtime CEO of the NBA. He's also been with Freddie Mac, an EVP at Wells Fargo, President and COO at Long & Foster, and he's currently the CEO of Mountain Lake Consulting. Well, welcome back, Dave Stevens.
Good to be with you guys. Thanks, Brian.
We're thrilled to have you. We're going to, and of course, I want to introduce our second guest, and then we'll roll right into it. Our second special guest may as well be the fourth guy at this point. Brian, what's this, your 15th, 16th episode, I think? We're going to have
not quite, but there's a few cameos.
Okay, well, we're going to
kind of like Newman on Seinfeld.
We could do that if you like, Levy. Of course, he is of counsel at Catton Temple and in Milwaukee and Chicago. He's in Milwaukee today, I believe. He is also the author of maybe the industry's best or one of the best mortgage blogs out there. I'll go ahead and go out on that limb. That's called Mortgage Musings. I can't recommend it enough. Ladies and gentlemen, welcome back, Brian Levy.
Well, thank you very much, Brian. Appreciate that compliment.
We're thrilled to have you guys. I'm going to make a quick plug for Content Beacon here. We are the only, and coincidentally, the best B2B content marketing agency in the mortgage industry. So if you'd like one of your own podcasts or blogs, white papers, whatnot, give us a ring or shoot us an email, brian@contentbeacon.com, rick@contentbeacon.com. And even if you want nothing to do with Content Beacon, but you'd like to see some folks on the show or have some topics, please, by all means, send us an email. And with that, let's get to our special guest. We've got a lot to talk about, guys. So, Dave, last year around this time, we're talking about a potential liquidity crisis that would have been spurred by the COVID-induced surge in forbearances, a little bit of hesitance on the part of FHFA Director Calabria to act. The story has changed a year later, but we've got a lot going on now. And Dave Stevens wrote an article in Housing Wire for April 19th, 21. Check it out if you haven't already. Very well written, very well reasoned. And I'm going to let you speak in your own words, but in essence, there's a suggestion that perhaps Director Calabria is attempting to shrink the footprint of the GSEs. But without putting words in your mouth, Dave, we've got a lot to unpack here. Tell us a little about what you're thinking.
Well, yeah, I've been pretty critical of Director Calabria since he came into that role, particularly with the onset of COVID and the CARES Act. and how that was implemented in the very beginning. But there's been so much here that the director has done, chipping away at the footprint of the GSEs, and I don't think it's a question whether it's an if. Mark has a history of written discourse in public testimony in front of Congress, some of which he republished under the Cato Institute banner, talking about what to do with the GSEs. And I referenced it in my article that you just talked about. It's on the front page of Housing Wire right now on the website. So if you get a chance to look at it, but all my articles are listed in Housing Wire. You can just search my name and it'll come up if it's depending when you get to it. But
and we'll include a link today. Yeah, we'll get some.
Thank you.
Yeah.
And I will tell you, just before I quickly go through the concern, the email response I've had from CEOs of our industry across the country, as well as former executives of the GSEs and senior executives at the home builders and the American bankers and more, has been pretty impressive. Just how much it resonated. Look, Mark, I use the analogy in my article of the proverbial frog in the pot of water that says, if you throw a frog into a pot of hot water, he'll jump right out. But if you drop it in a pot of cold water and slowly turn up the heat, he'll boil to death. I think Mark is slowly boiling this market to death. And it's unfortunate because this has been a really weird year. And thanks to COVID and the CARES Act and the Federal Reserve, and primarily the Fed, we had the biggest year, at least according to MBA numbers, biggest mortgage year in U.S. history. Some argue it's second to 2003, but right on top of it. So, you have a $3.8 trillion year. We made literally billionaires out of non-bank CEOs, many of them across the country. It's an absurd comparison, frankly, compared to the wrath of damage that it's done to the rest of the economy, but I'm not going to go down that rabbit hole. But in the period of that year, this director has steadily chipped away at the mortgage business. He adding this 50 basis point. I'm not going to talk about the lack of support for liquidity for servicers in the early phase of the Fed action and the CARES Act implementation. The first payment default policy put in place that caused suddenly refis to be pulled off the market, and then 600 basis point delivery fees if you sold one. And, we could go on and on there, but it really starts with the 50 basis point hit on refinances in a significant way. The capital rule that was put in place, which is overly offensive, particularly to risk transfer. So when you look at corporate capital standards, it should be a risk-based capital, and that should include anything that's been traded away through private credit transfers like CRT. But it's not given credit in the capital rule, which makes the capital challenge for the GSEs much more expensive, and to the point where the Harvard Joint Center for Housing Studies, Don Layton's up there now, but he wrote a piece with another author saying that the capital rule itself is going to raise G fees somewhere between 10 and 20 basis points when it's implemented. So Mark Zandi did a similar one. He's with Moody's Analytics. But even recently, on January 14th of this year, just 6 days before the Biden team took office, Calabria got an amendment to the preferred stock purchase agreement signed off on by Mnuchin, the CEOs of the GSEs, approved by their boards of directors as required, that had a whole bunch of provisions in it that affect our business. It had limits to multifamily lending. It had limits to loans that could be sold to the GSEs. One in particular says it had 3 elements: a FICO floor, a DTI floor, and an LTV floor. If you pass 2 of them, or cap, if you pass 2 of them, that loan is not saleable. I mean, affordable housing groups have gone ballistic on this because many minority borrowers might hit all 3, even though previously they were eligible for sale to the GSEs. That's now going to be restricted down just to a few percentage points that's allowed as total volume sold to the GSEs. It put a limit that non-owners and second homes have to be limited to no more than 6% of all sales to the GSEs in a rolling 52-week period. According to MBA, non-owner and second homes total volume in their chart of the week from just a week ago, in terms of purchase transactions, it's 14% of all purchase transactions. So, the GSEs are limiting it to 6%. And suddenly we saw basis point haircuts added to investor properties and non-owners, somewhere around 200 basis points by most investors. Again, shrinking the footprint out of investor and non-owner, something, by the way, he said specifically should be done in testimony that I linked to in my article. And he said that a decade ago. So he's keeping true to his word. He put a limit on cash purchases. Now that's really important because in his testimony, he talked in a previous testimony, not the one I linked to, but another one that same year, he testified that there was too much business being done by undercapitalized non-banks. That's my daughter in the background. Undercapitalized non-banks, and that there should be an effective effort to shift more of the risk back to banks that he states are better capitalized. Well, this move will do that. He limits the sale of loans sold to the cash window to no more than $1.5 billion in any rolling 4-quarter period. $1.5 billion. I consult for many non-bank clients, and several of them, if you're 10 billion-ish or below in terms of annual production, you likely lean a hell of a lot more into the cash window than you do through securitization. And so if you limit it now to $1.5 billion, it comes down to one of two things. You're either going to have to get into securitization directly, or perhaps merge with another company to make you bigger so that securitization makes sense. We're seeing some of that activity happen. Or you're going to be going to sell to correspondent lenders, i.e. back to Wells and others who are, I think in the director's view, better capitalized. So, limiting non-banks, activity with the GSEs directly, unless they're larger and more sophisticated. By the way, that's going to affect community banks as well. Many community banks don't do nothing but cash window to the GSEs. They don't know how to securitize, so it's going to impact them as well if they have any volume in mortgages of significance. Limiting investors, non-owners, putting a haircut on refinances. All of this is in the Calabria playbook. His view is that, and he has stated this publicly in the past, that the GSEs are pro-cyclical entities in the market, meaning not only are they counter-cyclical meaning that you're there to provide liquidity when the markets contract. Pro-cyclical, in his view, references his perspective that the GSEs are so big that they actually and so require far less capital and have this very large footprint due to loan limits and more, that they crowd out the return of private capital. And I think in his preference, if he could, the first point of execution for any loan in America would be to a balance sheet that the taxpayer is not guaranteeing. So there's a lot more to unpack out of this, of his actions, but it's been step by step. I mean, the heat is turning up on the pot of water that the frog's been sitting in. And as I say in my conclusion, why would you not think it's going to come to boil if he's allowed to stay in that job? And I'll just end with this, guys. I'm not the only one who's looking at this. Chris Whalen, who many of you know, he published a piece on the institutional risk analysis months ago saying Joe Biden should fire Mark Calabria. I mean, blatant cry for this. I am just personally surprised, having been the head of a trade group, that they're still, not just the MBA, that all the trade groups are still trying to play the polite path with a guy who's actually deliberately working against the interests of their business. I got an email from one of the largest non-bank multifamily lenders in the nation yesterday saying we need to get this out there. I had another executive say, can you paper this all over Capitol Hill? which, by the way, my article is going to be sent to every congressional office tomorrow.
Wow.
But it's a really big deal, and I think what we have is an industry that made too much money, just didn't care what products you didn't have and what prices were on it, what interest rates were, didn't really matter, because frankly, to use the expression of fat, dumb, and happy, that's exactly where the industry has been, with a real lack of foresight in terms of how all these actions are going to affect the industry, infect the industry strategically going forward. So I'll stop there, but that's the gist of the article, and maybe you don't have to read it after what I just covered.
Not at all. I suggest everybody read it. We'll have a link up there. And of course, Chris Whalen has been, if it's possible, maybe even more blunt about
Yes.
it, where he has not minced a vowel or a consonant in terms of his discussion. And you both, it sounds like you agree that the end game for Calabria would then be the privatization of GSEs and a secondary market, would you say?
Yeah. I mean, look, and I know, Brian, I know all you guys look at this, but when Mark he really wanted to release the GSEs from conservatorship with a consent order, or at least have explicit language in this most recent January 14th amendment that would have set the specifics as to when they will get released from conservatorship under a consent order. And I think as part of that, when you look at the PSPA, all of these restrictions that were thrown in that really do shrink the footprint. And by the way, he never gave the heads up call to Bob Brooksman at the NBA, I don't think. Hey, Bob, we're putting this stuff in this amendment. I want you to be aware of it so you're not surprised.
Wow.
That's the call I used to get from both Ed DeMarco and Mel Watt when they were, frankly, both representing both sides of the aisle. I think this was snuck in intentionally. I think he really also wanted to get the additional language in there that Mnuchin wasn't willing to go that far on. But he would like to see the GSEs released, have them go back to their implicit guarantees as chartered under their initial chartering legislation, something that PIMCO has published, has written in multiple articles. I referenced it in my article as well, the PIMCO piece, stating that global investors are not going to trust that the U.S. government will be there to back them up next time, likely causing a downgrading of mortgage-backed security ratings. And as you all know, in the MBS space, there are many sovereign investors around the globe that buy MBS as one of their investment sources, but they have limits to what they can buy. It has to be AAA. So they're not going to get involved with a company that could lose theoretically its AAA status, and that's what PIMCO warned. So all of these moves, I think to your point, yes, I think Mark would like to see these two companies released from conservatorship on an implicit guarantee with extraordinary expensive costs of capital that raise G fees, and with limits to the activities that they can participate in the mortgage market, in an effort to essentially crowd in private capital and get the taxpayer theoretically off the hook, even though we all know a lot of that business is going to shift to FHA, but nevertheless, they'd get off the hook of a lot of that business. And I think that's his intent, literally turning the GSEs into only counter-cyclical creatures, meaning if there's a true credit event where credit is not available for mortgages, they're there, albeit at a higher price, but they would be there because they theoretically be in the background, but not there in the forefront. And as I point out in my article, I'm not necessarily against all of that, but I am against it doing it when we have no private market, no trust in, and Brian could talk to this extensively from his legal seat, but there's the roles of trustees, loan level disclosure in mortgage pools, originator behaviors on refinances and predatory convexity outcomes. I mean, there's so much that has to be done. Ratings agencies and the lack of trust in their overall bond ratings, the lack of ability to get anything AAA if it has mortgage insurance on it, even in today's rating world. All of this, we're not there yet, right? So Mark is rushing to get these guys to out the gates of the barn, and there's nowhere for this market to run elsewhere. There's no competition outside of the fledgling growth of the non-agency market coming out of places like Redwood and some PennyMac and some other groups that are doing some attempt to create a non-agency market, it's virtually invisible outside of jumbo.
Yeah. There's a lot there, and you've been very consistent on this.
Brian,
I'm sorry, go ahead. Oh, Brian, I was actually going to bring in at this point. I'm going to go ahead and bring in Brian Levy. I know Brian.
No, I was just going to say I could listen to Dave talk about this stuff.
Yeah, no, but we're going to put you on the spot here,
Sorry.
Brian. Since you've touched on several of these sub points as well in your mortgage musings, I'd like to kind of have you jump in here and add your comments as well.
Yeah, I was just about to say I could listen to Dave talk about this stuff like all day long. It's fascinating. He's so connected on us and knowledgeable. It's wonderful to hear from him. I completely agree with Dave what he was talking about in terms of Calabria's MO. He's a libertarian scholar. He's been very academic about his approach to how to deal with the GSEs and what their role should be. It's been no secret at all what he wants to do, what he wants to accomplish, and I think Dave did a great job of describing that. I would say that a year ago, when we were just coming into this COVID situation, we really didn't know what was happening, how deep it was going to be, what was going to happen to the economy. I mean, there was a lot of unknowns, and into that, instead of acting as a sort of government support role, I think we were really struggling with the FHFA's actions as an industry to try and maintain what we were doing in terms of keeping people in homes, allowing home ownership to continue, mortgage lending, refinancing. I mean, all of those things were occurring in a remote environment, and there was a lot of things that the agencies did do to enable that. But you got the sense from Director Calabria that wasn't really the role he was really focused on. He was still focused on this privatization, shrinking the footprint kind of role. Dave's absolutely right that refinance fee, it wasn't a risk fee at all. That was very disingenuous to suggest that there was no risk, additional risk associated with the refinance. It's hard to imagine what additional risk the agencies were taking on by lowering somebody's rate. And I wrote about it last April. This is not going to be the first thing that we're going to see. And then, of course, we had the 7% haircut on borrowers who were using the forbearance that the government was providing as a backstop to the temporary income losses that were occurring in the economy, and those extended for a long period of time for a lot of people. A lot of people took advantage of foreclosure and forbearance initially, and frankly, they didn't need it, and that was a good thing. And then they backed out, and so those numbers came back down. But what I'm hearing now is that the GSEs are gearing up again to gearing up the repurchase mechanisms to start looking at ways to push those loans back to originators. And and now we've got the CFPB moratorium on foreclosures that they're proposing. We've got a lot to talk about, but I completely agree with Dave. Is what's going on at the FHFA is this desire to continue to shrink the footprint, to boil the frog, as Dave says. I don't know where it ends up, and frankly, I guess I'm kind of curious from Dave's perspective. What role should Congress be playing here in driving the policy instead of this individual agency director? I mean, obviously, Congress had a lot of time to reform the GSEs, and and squandered it, frankly, and then we came to 2021 and we still had no release from the receivership. So I'd like to see Congress, frankly, step up here and tell the FHFA what the purpose of these agencies should be and how we're supposed to support the housing market, as opposed to giving so much power to one individual director.
Dave, you want to jump in there? Brian had a
yeah, I mean, look, Congress has tried to address the conservatorship multiple times through the infamous Corker-Warner, Johnson-Crapo kind of attempts at legislation. One actually did pass the banking committee, but never made it beyond that. I'm surprised that Sherrod Brown, frankly, who chairs the banking committee today and very progressive Democrat, isn't intervening on what Mark's doing. Here's one of the reasons why I think that's the case. I don't think that the collective voice of our industry is raising the concern, and we certainly don't have the consumer groups doing it. And if the Center for Responsible Lending or Consumer Federation of America or National Urban League or one of the more powerful community action organizations, as it were, if they were to go to the Hill and say this guy's really damaging, then some pressure could be put on either to get legislation done or to get Mark out of the job sooner. One of the limitations, and I know we're all waiting for the Collins case to be ruled on, but the single director of the FHFA, as it currently stands, can only be fired for cause. And I know for a fact that the Biden regime, the last thing they want to do is get into a fight right now with Calabria, who is a loved child of the Senate Banking Committee. As we all know, Mark started his career in the Senate Banking Committee. He worked for Senator Shelby, who at the time became chair of the committee, and Mark staffed him. And then he's worked for very conservative think tanks in Washington, D.C. You go fire Mark, you're like pointing a shot directly into a conservative, leader in their mind of this space of finance. And they think he's doing a good job, frankly. And so the Biden team sees a strong housing market, which we still have. We've still finished an amazing first quarter. Home sales are through the roof. There's not enough inventory. So the need to address this is not considered critical at the moment, and they figure they'll wait out Collins' case. And as we all know, Collins v. Mnuchin is a Supreme Court case that was heard in November of last year. We expect the court to come back in June-ish, hopefully, with a ruling. And if that goes the same way as the CFPB case, what was it, Sealy, I think, versus Cordray, that case ruled that a single directorship was not constitutional if it could not be terminated without cause. This Collins case has a lot of stuff in it about the sweep and more, but there's a statutory as well as a constitutional argument in the Collins cases. There's two of them, but the constitutional case comes down to whether a single directorship is constitutionally allowed if it cannot be terminated without cause. If they rule on FHFA like they ruled on the Bureau, which is what the Biden regime is hoping for, Calabria's out on his rear within moments, I would expect. Just like Kathy left voluntarily because she knew it was going to happen right at the change of control. So let's assume June happens, the Supreme Court rules, let's assume that ruling, at least for now, and there's debate as to whether it's going to go that way. Many of the shareholder lawyers think it's going to rule it differently. But let's suppose it rules in favor consistent with the CFPB case. Mark is then out, end of June, and an acting director is put in place. That's more in sync with, I think, the kind of outcomes that the industry would prefer for the time being until the private sector really does return and then a nominee gets nominated, maybe confirmed by late fall, something like that. That's how I sort of see this thing playing out. And but it all depends on that case. Brian Levy, I don't know what you think about that case. If you've looked closely at the Collins case, but folks I'm talking to think it's going to rule that way. We'll see.
So I did follow the Celia Law case pretty closely, and of course, what the Supreme Court did there was they severed that part of the CFPB Act that said that the director could not be fired, and said no, the director needs to be fireable at will in order to be constitutionally sound in terms of its due process provisions, and not, non-delegation and all kinds of other constitutional arguments. I think all the same arguments pretty much are present in the Mnuchin case. So I suspect they'll rule the same way, but not sure what would be that different with the FHFA director also needing to be removable at will at the president's direction.
Well, there's a lot there, guys. You've also anticipated a couple of my next questions. Dave, I'm going to come back to you and have Brian jump in. And if my failing technology, my ancient technology allows, we'll try to get to both of these. But let's start with the elephant in the room, the CFPB. Feels like we hadn't talked about them nearly as much for the last couple of years, but they're all over the headlines now. And, Dave, if I'm in servicing right now, I've got to feel like I've got a target on my back. In March, oh, go ahead. I'm sorry.
Go ahead, Brian.
Well, I'm just teeing it up here. The CFPB director is rattling the saber. We've got some proposed rule changes that would pause foreclosures. There's quite a few different things there, but let's get straight to it. Talk a little bit about kind of the new again, or old but new posture of the CFPB, especially towards servicers.
Yeah, I mean, it's funny. I get the point about political administrations, and when you go through a regime change, the new team wants to do stuff. And so this CFPB is a new administration. They're a regulator with enforcement capabilities. They want to do stuff. I thought that their focus would be more on payday lending, student lending, because all the rules that make our industry what is really a safe and sound industry were established during the Cordray years. And that includes a national servicing standards rule that the Bureau issued that puts in place a waterfall that servicers are obligated to follow and ascribe to in order to give a borrower every opportunity to reperform. So that being said, the Bureau came out guns a-blazing from day one, even before the director started the process. The acting director, who was also in the Bureau once before, put a halt to the implementation of the final QM rule, which, by the way, that conflicts with a little bit, could cause some conflict with the PSPA amendment. I won't go down there unless we need to, but they put a halt to the final QM rule. This final QM rule was important because what the PSPA amendment says that I referenced earlier, that Calabria put in place, said, we're no longer going to allow you to underwrite to the patch. You've got to underwrite to the rule, the new rule that Kathy Kraninger's team had put in place, that had been worked on and litigated for a couple of years with consumer groups and industry. And it says that it has 150 basis points over APOR limit for a safe harbor QM rule to be accepted, and a 225 limit, I think, for it to be QM at all. And so the GSEs were putting a policy in place that says you got to be within that limit on the QM safe harbor. And 150 basis points over APOR should work for virtually any lender selling a GSE loan, because APOR is a Freddie Fannie rate, basically. So anyway, all this to say, that was the first sort of shot over the bow. Then we started hearing statements about, servicers better be handling their borrowers safely. We're going to be watching out for them. We just had a recent statement. It was in actually article about it in the Banker yesterday by Kate Berry, talking about how the CFPB is going to be reviewing the outcomes to minority homeowners. And so, not to say they shouldn't, they should. But anti-discrimination rules are already in place at the Bureau. The servicing standards rule is already in place. This is a bit worrisome. I think we may have ourselves an activist regime in there. I do know one of the staff people who returned and actually was instrumental in stopping the implementation of the final QM rule is a woman who I met with when I was at the MBA, who argued that there should be no safe harbor. And you have like the National Consumer Law Center, the NCLC, their CEO, who I had several meetings with over the years, used to argue with me that lenders should have to defend every foreclosure in court. So you do have that more activist, consumer protective voice that has, I think, going to have a bigger ear in this administration. I actually sent out an advisory to my clients yesterday that they need to make certain that any loan action, whether it's a counteroffer or a decline, for any minority borrower has to get at least second level review. And I think most companies do that. I'm not sure they all do, especially some of the non-banks that aren't as experienced with enforcement actions. But, we saw this before where the Bureau would come in using UDAP on unclear rules that had not yet been in place and issue CIDs, and all of a sudden we see these big enforcement actions taking place. I'm not sure what's going to happen here. The interesting thing is, servicing, while non-banks have a lot of it, it's concentrated on the big guys. In fact, I have one client, I better not say much about it because it's a very large non-bank originator, very large, but they don't service loans. And so it's really going to come down to how are borrowers handled on the exit from forbearance, and most importantly, for those that are not able to essentially reperform. I can't call them reperformers because they're not supposed to be considered non-performing, but nevertheless, those that cannot reperform and continue paying their mortgages, how will they be treated, and what will be the options provided to them? And I want to throw one thing out, guys, for you to consider. I didn't think there would be a lot of foreclosure activity after COVID forbearance because we have so much home price appreciation and the quality of underwriting was so strong going into this recession that I thought reemployment and forbearance would essentially cover it with, a lot of this being tagged on as liens on the backside, some with payment programs, but a lot of it tagged on with liens on the backside, meaning there's no increase in payment. They just got to start paying again. But I worry now that we're going to be heading in close to 2 years by the time the extension from the Bureau is done, or at least 1 3/4 minimum from when the April 1 implementation of the CARES Act took place from last year. We may have homeowners who have now been through, 1.5 years of no mortgage payments. And remember, some of them just said, hey, I just don't want to pay my mortgage. I could, but I don't want to. So, because it was open to anybody, now they're going to be looking at their home and saying, even with home price appreciation, I might owe more than the home's worth, particularly in an FHA loan. I put 3% down. Yeah, my home's gone up 10% or so over the last year, but I owe now deferred payments equaling almost 2 years of payments of principal and interest. Am I going to keep paying or am I going to walk away? And I don't know what's going to happen. I think people don't want to hit their credit reports. I don't think I don't think people like the strategic default option, but because there was no means test to get into this program, remember under HAMP, you had to qualify for HAMP. You had to prove your hardship. Remember the hardship letters that we provided, that the borrowers provided, or we helped them with, to prove hardship in order to qualify for HAMP. And then they had to meet the underwriting test. They had to do 3 trial payments and then go into a permanent mod. I mean, all of these controls were in place. It was difficult, but they were in place. This time it was, you don't have to qualify. You don't even have to need it. just wave your hand, you're in. And we don't know really, even as of today, what percent of borrowers who went into forbearance didn't need it. And hopefully that's a small number. But even for those that did, what percentage of those won't get fully reemployed to the point where they can make the payments? And, we're looking at default rates and forbearance. When you see 14% seriously delinquent rates on the FHA monthly scorecard for their overall program, I don't know. I don't know how I would bet on what the volume of demand's going to be for people in distress. And if it's really concentrated in the FHA program, I fear that it'll be more concentrated with minority borrowers, just because of the FHA distribution. And I caution servicers to do what they need to do. And as we all know how servicers behave, Brian, you've been in that side, of course, but you'll pull the loan out of the pool and get it current, and then maybe sell it as a reperformer, or maybe just hold it on balance sheet rather than put the insurance claim in because of the risk involved for False Claims Act enforcement from HUD, let alone what the Bureau may do. I don't know how everybody's going to play this one. I think it depends on how big the number is and what the challenge is, but I do caution the industry to be really freaking careful with your servicing organizations, and you better have great servicing managers who are have the game plan wired as to what to do. I expect that's what's the case is, that the servicers are prepared for the outcome here, but this endless forbearance stuff is difficult. And Calabria said yesterday in his MBA comments, as we all know that were published in a few housing trades, that endless forbearance is not good, and we're going to be providing input to the Bureau. I'll leave you with this with one last thing. When the proposed rule to extend the forbearance period out to the end of the year was announced, I emailed a whole series of CEOs who service mortgages, and I asked them for their feedback. I promised I wouldn't use their names. The response was basically, hey, we expected something like this to happen. It won't kill us this one time, but they can't keep extending it. The more important concern from servicers is the Bureau is coming in, intervening in a part of the market that was already established under rulemaking in a democratic regime under Director Cordray called the National Servicing Standards Rule. And that covers how you have to handle people who go into default and how consumers should be protected. To now suddenly intervene, beyond the CARES Act and beyond rules already put in place, and to start directing credit policy to lenders that may cause them to violate contractual covenants with their investors is just a weird precedent. So,
Well,
long answer.
Well, no, but and again, a lot of good stuff there, Dave. I'm going to ask you, if we have a little time here, I'm going to come back and ask you to look back in that crystal ball. So be waiting for that. But I'd be remiss if I didn't allow Mr. Levy a chance to comment on, I'm pretty sure you've heard the term CFPB every day of your life, Brian. It's probably just a little part of your practice.
It only started in 2012, so not every day of my life.
I feel like you're ready to burst out of the gates, so by all means, please weigh in.
Yeah, I don't think there's any mystery here as to why the CFPB is focusing on servicers. Dave will I'm sure back me up on this, that really, the CFPB and its entire sort of raison d'etre was driven by the mortgage business and the meltdown of the last decade, 2008, 2009 time period. And yeah, there was, Liz Warren and her concerns about financial security general and consumerism. But at the end of the day, it was the mortgage meltdown that drove Dodd-Frank Act, which drove the CFPB. And here we are looking at returning to a more activist, democratic controlled CFPB and administration, and we've got a a mortgage situation that deserves attention in some way. What's going to happen with all of these forbearances when they stop? Okay. And so I think, this is just, we somehow, for some reason, we treat the mortgage business and in mortgage lending very differently than other consumer lending, consumer purchase situations. We as a country just don't allow people to fail on a mass scale in their mortgages. Whereas, I don't think you see a great outcry against subprime auto lending, in the way that you do a subprime home lending, where the risk of default is really great. And that's just, something that we as the mortgage industry have to deal with. So whenever there's a situation, and this wasn't our own doing, of course, this is a virus. The mortgage industry did not cause this one, but we are going to have to deal with the fallout of that. And that's why I think the CFPB is focused on it. I agree with Dave. They passed a law, or they passed a rule to deal with defaults. Are there some special circumstances here that maybe deserve additional attention? Yeah, there probably are. The proposed rule that they've got out there has a lot of good stuff about, accommodating borrowers. But at the same time, if you tell borrowers, no one's going to foreclose on you no matter what till the end of the year, what is the rush? What is any urgency for you to do anything in terms of what your other alternatives are? Why are you going to even engage in a discussion about default alternatives and modification or any of that? Because you have no consequences if you don't. And I think that's really the problem with this idea of just a blanket moratorium that, and by the way, what they're proposing, it doesn't even apply to just people who are impacted by COVID. It's everybody. And they have a definition in this proposal about a COVID impacted or something to that effect, somebody who's financially impacted by COVID, but they just assume that everybody should get this relief. And I'm just really troubled by that kind of blanket authority to just, interrupt the sort of the normal contractual rights of businesses and individuals, because, and again, I think their reasoning is really flawed too, because it's premised on this idea that, well, consumers just aren't thinking straight right now because they're impacted by COVID. They don't really make good financial decisions, and I'm somewhat insulted by that. I know we are all dealing with COVID in different ways, and some people probably are struggling with their financial decisions, but not everybody. And for an agency to make that sort of leap of faith, I think is really, that my last musings, I talked about how this idea that government saying that you're not thinking right is very troubling to me. We can all talk about dystopias, but I don't like it when somebody thinks they're smarter than me and then tells me how to live my life. As opposed, and you know what, Mark Calabria probably thinks very similarly to that and wants to get the government out of mortgage lending. But there's a time for government. And I think, providing some accommodations to borrowers in a pandemic certainly makes all the sense in the world. They've got something in there about 120-day sort of grace period where the parties are supposed to negotiate back and forth a little bit more about options. I like that. I just don't like saying nobody's getting foreclosed on until the end of the year because you're all not thinking straight.
I think we can all agree with that, Brian. And I've got one more question for you guys, and we're running out of time, so it's probably not even fair to ask it. But if you have a shortened memo on the crystal ball, let's start with you, Dave. 2021 is, a year ago at this time, it was COVID for, forbearance COVID. And although COVID's still sticking around, there's a lot of things going on in the mortgage industry, as we've just discussed. We're also going into maybe our first true, maybe extended purchase market in quite some time. We've been threatened with it a few times in the past 15 years, but this looks like this one's for real. We've got an industry that's flush with cash from 2020, as you both alluded to. We've got some of the most aggressive M&A activity, some IPO activity, a lot of interesting stuff. It's a great time to be a media relations guy, I'll tell you that much. But Dave, we got 6 to 12 months ahead, and who knows what would have been predicted from last year to this time. I'm going to ask you briefly, what's ahead for the mortgage industry, or if you like, the greater economy here when we get back together, hopefully next year at this time?
Yeah, so I mean, Kevin's new company is a perfect example of this M&A activity going on. This economy is going to roar on fire. There's so much stimulus in this economy. We saw folks spend the $600 checks like crazy. They're now just getting $1,700 checks. Mark Zandi, the economist from Moody's, I won't pull up slides, but he has a great deck on why this economy is like just going to blow wide open. One slide he has is savings and reserve after expenses and how it's trended up so significantly. Americans are sitting on a lot of cash, more cash than they've had in generations, frankly, net of expenses. And home ownership demand is extraordinary. You pass an infrastructure bill on top of the most recent piece of legislation for COVID protection. We're just going to have an extraordinarily strong economy. Most economists, the economists are pulling expectations from Johns Hopkins, frankly, but the viewpoint is we're going to reach herd immunity by late summer. We're about to have summer. The nation's opening up. We even saw the little burst last summer because people could go out. Airlines are starting to fill up. Hotels are beginning to get bookings. We're all vaccinated. This is going to be extraordinarily stimulative, and that's why most people expect that while the Fed will keep short rates low somewhere into next year, that we're already seeing the steepening of the yield curve, the 10-year. It's bumping around a bit, but don't let that 150 handle from yesterday or the day before fool you. The trend line is definitely up for mortgages. And both, if you look at Fratantoni from the MBA and you look at Zandi from Moody's Analytics, two great economists, they're both seeing rates solidly in the mid threes by the end of the year, solidly in the mid threes, and in the fours a year further out. The MBA forecast is for loan origination volume to be down $600 billion this year over last year. And most of that's going to be in the second half of the year. We front loaded a lot of the volume for the year this time because of all the refi activity. We had a huge first quarter. Everybody did, and good second quarter going on, but you're going to see, I think, a pretty pronounced shift as we look at the second half. So all that means for the business, we're going to see several lenders who recently went public, whose shareholders really don't understand the volatility of owning a mortgage company. I mean, if you're a bank investor and you buy their shares, they have diversified investment options. Mortgage companies, non-bank mortgage companies are relatively monoline. They're going to contract, and that's going to cause pressure from shareholders, as well as some of these big non-banks that have Wall Street owners that want to see performance. And that's going to cause margins to compress. There's going to be excessive rate competition from the Quickens of the world and others. I expect UWMs and more that'll be just smattering around the market and cause others to lower down to that level in the dirt to fight it out. I think to your point of being flush with cash, I've talked to a lot of IMB CEOs who have, put the money in the bank and want to sell the company. And so I think that the M&A activity, as you pointed out, Brian, going to be huge. It's already huge. I think it's just only going to continue to grow. And I don't think loan officers are prepared for this next decade. We've had, many of my clients, even their branch managers, started in the business in the mid 2000s. And so all they know, many of them started around 2007 or 8 or 9. All they know is quantitative easing, the Fed stepping in and driving rates to 2.5% or 2.25%, whatever it ultimately bottomed out. Refine your clients over and over again. Many originators today are over this last year ran 70 to 90% refinance. Good purchase originators were somewhere between 60 and 70% roughly on average purchase. So they still had 30 to 40% refi. It's going to be a very different business. And I think, to your point, this is the end of the cycle. I talked, Barry Habib always says we're going to have another recession and rates are going to come down again in a year. I don't think that's going to happen. I think we're going to have, at least for the next couple of years, an actually really strong economy with huge employment growth, going back to full employment by the end of 2022. And, great for America. But our business, mortgage business, does actually pretty well in recessions because the Fed steps in and creates all the refinance opportunities. And so, we've gone through 30 years since 1980 when rates hit 18% of just a progressive decline in rates with limited interruption in between. Coupon burnout is going to be pretty tough. Like talking someone into a 3.5 or 4 when they're sitting at 2 3/4 or 3 1/4 takes a really good salesperson. So I would just say this is going to be an interesting time as we move forward. And strong purchase originators who are good at cost control are going to survive. I think, merging two large behemoths like we just saw was a smart move because you can monopolize on consolidation of your operations platforms, and that can reduce expense while hopefully keeping your productive production units active in the market. All of this to say it is going to be a washing out period. We're not there yet. It's hard to believe because everybody finished off an amazing quarter. I think Q1 was better than maybe Q4 and certainly significantly larger than Q1 last year. So everybody's thinking this gravy train is going to keep running indefinitely. You're already seeing Q2 volumes are a little slower, not the full impact yet, but the inventory challenges and lack of refis, I think, are going to really dictate the second half of the year to us and the following year.
But then remember, there was a time, not that long ago, when 4% sounded like a great thing, right? It's all
exactly
historical perspective.
Yeah.
So, Brian, we've got just a minute or two, but I'll give you a chance to maybe add a comment or two there, and then I have one last brief question for Dave. Brian, 2021, go.
Yeah, listen, I'm not going to make any interest rate predictions or where we're going to be in the housing market. I'm just going to say that David is absolutely right again that this is a cyclical business, and that if the cycle doesn't come later this year or next year or the year after that, it's going to come. It's going to come eventually, and then we're going to see things change. I am seeing a lot of mortgage companies who have done very well over the past year start thinking about, what am I going to do with all this money that I just made? And they want to try and find ways to get more purchase money business because they know that the refinance is going to certainly slow down. Trying to find other ways of working with realtors and builders, joint ventures, marketing services agreements, but other ideas as well to try and help buyers right now who are trying to purchase homes in frothy markets where they need to have bids that are, there's bidding wars going on and there's very little inventory, and so mortgage lenders looking for new ways to support that kind of purchase with appraisals that are not coming in for what they want. And there's a lot of challenges, but I guess what I would do is caution that whatever you're going to do, if you don't depend on this frothy market continuing forever, David will say, well, you can count on it for a couple more years, but just don't count on it forever and try and stay ahead of when that's going to change, because if you're, at some point the music stops and you don't want to not have a chair.
Yeah, fair enough. Dave, well, got one last question just for you, very briefly. Last time you were with us, you shared what was going on in your personal life, some of your non-industry interests, some of your nonprofits, some of your advocacy as well. What's new with you since we last talked?
Yeah, so we've, as I've been very public with our industry, I've been fighting, I have the kind of cancer you don't get rid of. And as my team at Johns Hopkins tells me, so my oncologist actually isn't even listed as a doctor at Johns Hopkins. He's the head of research, Ken Pienta. So I'm one of his guys. You can call me a guinea pig, but it does mean I'm on treatment protocols that oftentimes aren't available to others. And he yells at me constantly, and my wife chuckles in the background that stop looking at the internet, because if I was anybody else under normal care, I would, 97% of men with what I have would be dead by now. So it's a really sobering thing, the impact of this cancer. But right now, my levels are barely detectable. In fact, I'm getting tested early next week, and I might be undetectable next week. And I'm over 4 years. I'm on year 5 into this cancer that defies statistics in terms of where we're sitting right now. But as a result, Ken Pienta and the research team at Johns Hopkins have made a massive breakthrough in metastatic prostate cancer, but it's a breakthrough that will affect all metastatic cancers. Metastatic just means a cancer that is spread. So breast cancer, if it's spread into the lymph nodes, out of the breast, into the body, it's metastatic. It's very similar. In fact, I've sat in waiting rooms with men and women, all with similar cancers, breast and prostate. But the breakthrough is extraordinary, and Johns Hopkins is a research hospital, so they depend on contributions to be funded. We started a campaign 3 years ago, I guess, at this point, called Stephen Strong, my wife and I did. And the industry really jumped in and contributed tons of money, and we raised hundreds of thousands of dollars our first year. In fact, you can Google Stephen Strong; it'll show up. All one word.
We'll put a link in the notes too, Dave.
Thank you. So we raised a lot of money the first year. We raised some in the second year. Early this year, I went out with an effort to our industry, and just a few months ago, when we've raised $640,000 to date on this particular drive, and it's really been extraordinary. I don't want to name names, but I'd miss too many. But there's CEOs from across the country who have personally written checks, very successful non-bank CEOs in particular, but even folks like Jonathan Cord, Ellie Mae, and Jim Deitch, and there's so many, Eddie Perez, Jake from Fairway, Bill Landon from Georgia May. I mean, I can just go on and on, that these folks have dug deep and made huge contributions. And we've allowed the Hopkins team to buy, it not only found this breakthrough, they're buying additional equipment so they can test cells quicker and try to get a cure. And top oncologists from around the globe are coming to Hopkins to work on Ken's team and leaving their seats. The person who has the Einstein seat at Princeton left his chair to come to Hopkins and work on Ken's team. So, I mean, it's really incredible what happens when you find that hub and can support it. So that's our primary focus for philanthropic activity, but we have other causes as well. And for me, I plan on kicking around a lot longer. I get texts from friends in the industry. How you doing, Dave? Who haven't seen me in a long time. And I type in automatic reply, Dave is no longer with us. I'm really sick humor.
Yeah.
And then I send it, and then I quickly do a follow-up, just kidding, haha. you get a certain perspective when you fight cancer for a number of years, and you gotta laugh with it a little bit if you can. But we don't laugh all the time, but we try to.
Well, Dave, you got a whole industry cheering for you here. Certainly, we're going to expect to see you back next year around this time. If not before then, we hope to have you back. Folks, check it out, Stephen Strong. It will be in the notes. I can't thank you enough for joining us, Mr. Dave Stevens, and also our friend Brian Levy. Guys, thanks for being here today. I'd love to let us go another half an hour, but as you know, we tend to record on an old iPad. Well, it's finally hit an age where it's with the IT guy more than me. So I've rigged up an Apple Watch, and it's telling me it's time to get up and move. So guys, thanks for being here. We're going to do this again. Take care. Mr. Grant, take us home.